Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, quickly, we've got Salih Yilmaz joining from his usual perch in Dubai, swinging over to Madrid. We've got Patricio Alvarez joining, and then hopping across the pond to sunny Florida. We've got Mike McGlone uh, down in Miami, and it looks like I'm the only one who got the memo about the ugly Christmas sweater. But anyhow, we'll start with you first, Mike, because I know you have to leave early, and I want to get your take on kind of how to be thinking about commodity markets in 2025. You've got a note out that talks about crude oil's path to $40 a barrel. So tell us what you're thinking there.
First, you have to show us the rest of that sweater, Rob. I got to see it. You showed us earlier. Show us that shark. Come on.
Well,
Look at
I'm not
that.
sure
Not bad.
everyone can see, so I'm gonna have to talk again. But a
Oh, we
lovely
can see it.
shark,
I
very
love it.
very Florida themed.
I love it. Well, I do have to hop early, and partly it's the thing I like to say in my business, in our business, is when they stop asking you to comment, then you know you have a problem. They want me talking on the radio. Guess what? About Bitcoin, and I start there because I think it's indicative of what's happening with rapidly advancing technology and commodity prices. It's hitting at the most significant stage in history. Now, this is predicted by the book by no, The Price of Tomorrow by Jeff Booth and by The Domino Effect. Brazil was the author. These are two key things that are really happening. So I'll start with crude oil. It's been a fact that crude oil's pivot since it first peaked around 40 when Saddam Hussein invaded Kuwait, that it's been pivoting around 40 and making lows below 40 since that peak in 2008. That's the trajectory. So right now, $70 a barrel. To me, the next $30 is very unlikely to be above 100. We know the risks would be if it does that, it'd be some kind of supply shock that we all don't want. And the normal trajectory is towards 40. And the key quote every day and key word to describe energy, most commodities now is glut. And that's not just energy, it's not just crude oil. It includes most notably the grains. So I'm putting the finishing touches on my outlooks for commodities next year. And it's a key fact of what happens in typical cycle of commodities. When you get too expensive, they must always get too cheap. And the too cheapness is versus endurance is typically enduring. So let's talk about break-even costs. It's a normal rule in commodities. How do you define it? Where they're from? The break-even cost for the world's largest producer of crude oil in the U.S. is $56 a barrel. So I think we're going to see that next year. Break-even cost for corn is around 375. The low this year was right around there. You typically have to do that. The break-even cost for natural gas and world's largest producer and exporter to the U.S. is below $2, around $2. Now we bounced. It's winter. We should have bounced. It's around 340. The risks are we get a normal, warmer than expected winter, which is the trend, and we go lower. But the bottom line is, this is a normal trajectory in commodities. The key thing for next year for macro is, okay, maybe we'll get lucky. And so the number one thing is U.S. stock market has to stay elevated. Up 30% in a year, and gold's still outperforming up over 30% is a bad indication for over equity. So let's say the first risk for all commodities is we just have that normal 10% correction in the stock market. Now, Gina Martin Adams, our equity strategist, points out how expensive they're getting. And also with these Trump tariffs kicking in, my sense is the new Trump administration is going to rip the band off right as soon as possible, get it over with. And which means potentially an equity balance value at risk models pushed on all commodities with the exception of gold. So the question is what stops it? What changes its trajectory? The difference from any other cycle in the past is significant deflationary forces from China. Every day that goes by, we have to depend on more cuts from OPEC, more stimulus from China. That's indicative of the problem in the country in the world. And I just look over at 177. That's the yield in the Chinese 10-year note, and the U.S. 10-year note yields at 439. I think the U.S. 10-year note was more likely to tilt that way, particularly if U.S. equities decline. And the number one commodity that has to go up, crude oil's kind of stuck, is copper. The doctor copper. If it goes down right now, it's around $9,000 a ton. If it does what it normally does, reverts to 7,000, that means the whole global deflationary dominoes follow China, follow Germany, follow Canada, follow Brazil. I have to keep mentioning the countries, follow the South Korea. I mean, the world's tilting towards this deflationary trajectory you'd expect after the big inflationary pump. And then most of these major countries I mentioned are all exporters to the U.S. and they're going to face tariffs. So the good news, it's a great trading environment. It should be good for gold. And there's going to be spikes. It'll be pretty good, decent spikes. So I look at levels around WTI, maybe near 80. We get there, be good levels of spike. Corn maybe around 5, soybeans maybe around 11, and gosh, let's see what happens with copper. If can it get to $10,000 a ton? I think it's more likely to go 7. So that's overall outlook. It's bearish for commodities, but I think it's a great trading environment. And the bottom line is for me, for by the time we get to this point next year, the U.S. stock market has to be higher. We should expect more deflation from commodities. Back to you.
Okay, thank you, Mike. Salih, I want to get your reaction to that. I find Mike's first line from his note the other day is quite interesting. The word glut is increasingly synonymous with crude oil as supply surpluses rise and China's imports fall. But do you concur with that general view? How are you seeing the fundamentals in the oil market looking out into 2025?
Yeah, sure. I mean, I do agree generally that when we look at the balances in 2025, it looks like, at least in the first half of the year, we will have a glut in the crude oil market. And the IEA expects, even if OPEC Plus doesn't bring any additional barrels into the market, even if they don't, we will still be in an oversupplied market all the way through next year. So generally, I think I would agree with Mike that oil prices would probably be closer to $40 a barrel, maybe even lower, if it wasn't for OPEC Plus very actively and aggressively trying to protect the price floor. But I think the reality is that they are trying to protect the price floor, and they've shown that they will continue to stick to their strategy of trying to get a higher price over losing market share. And we've been arguing that maybe there will be some internal tensions, maybe some key and important members will start saying that we can't do this forever. Perhaps maybe we should switch strategy. We should focus on market strategy, market share again, rather than keeping prices high and subsidizing all that production from outside of the group. But earlier in December, they had a meeting and they once again decided to extend their current level of output cuts. So they will not bring any additional barrels on January 1st. They've delayed that all the way to April. And unless something changes, it looks like they will stick to the strategy. And as they do, that price floor, I mean, I remember earlier in the year, we were arguing that the price floor they're targeting is $90 a barrel. Then that's gone down to $80 a barrel. Now they're probably trying to protect $70 a barrel. But the reality is that they are keeping a significant amount of oil out of the market artificially to support prices. And it's, at least to an extent working. So, yeah, when you look at the balances, it looks like they will have to even come end of the first quarter, unless demand really surprises to the upside, or non-OPEC plus production in the first quarter of next year surprises to the downside. We don't really see a lot of room. I mean, we don't really see any room for OPEC plus to bring any barrels. So I think it's going to be a little bit more of the same. They're going to realize there's no room for them to bring any barrels. They probably extend for another quarter. And then I think we're going to start talking about whether the second half of the year looks any different. It could, I think looking at the last 2 years, demand has been very underwhelming. So I think a lot of analysts, a lot of investors are looking at the demand picture very cautiously for next year. But, I mean, especially China has been very underwhelming. Demand in China has been very underwhelming. And we still don't know if this is structural, if there's a serious paradigm shift, and maybe we should expect not a 4 to 6% oil demand growth in China. Maybe the new reality is 1 to 2%. We don't know. Obviously, they've had a lot of difficulties, turmoil in the real estate sector, which has had an impact. But I think early next year, we will have a better picture on whether Chinese demand will come back to its perhaps pre-pandemic trend, or this will be the new reality for Chinese oil demand. So all of that combined, yes, I think there will be a lot of downside catalysts for oil. I think there's going to be a lot of pressure but we shouldn't forget that OPEC Plus is there aggressively trying to protect that price floor. And as Mike mentioned, geopolitics are still in play. We always talk about, I mean, for the majority of this year, we talked about the conflicts in the Middle East and between Russia and Ukraine. You could, I mean, we really haven't really gotten any real and actual supply disruptions, but with these geopolitical risks, the risk always is that these can turn into disruptions to supply, and that can, of course, be a huge upside catalyst. And I should mention that at least in the last week or so, the geopolitical driver has been potential sanctions, not only on Iran with the new Trump administration, but also on Russia, either more sanctions or just simply stricter enforcement of current sanctions. So OPEC plus, the aggressive OPEC plus out policy, plus potential geopolitical developments, potential new sanctions could be upside catalysts as well. But those aside, we do see a relatively loose oil market balance, which means continued pressure on prices, at least in the first half of next year. Sorry for that long answer, but that those are generally our thoughts on the crude market for next year.
Okay, fantastic. Patricio, let's bring you into the conversation. If I can ask you to be brief so we can circle back to Mike before he has to hop. But just quickly, can you frame your sense on the gas market as well? Do you agree with Mike's bearish take?
I think it's a bit different to Mike's take if we look at in relation to last year. So last year, European gas prices perhaps reached the bottom. They fell pretty sharply to almost 21 euros per megawatt hour from about 130 euros per megawatt hour on average in 2023. So we've probably seen the bottom of European gas prices. And what it seems to be happening is that we've seen a tightening gas balance here in Europe, and that's mainly because we had a very cold start to the heating seasons. They were to the heating season this winter. It's been 2 weeks in November that drew on storage pretty stiffly. But now we've seen a spell of warmer weather again. So prices are stabilizing at around 40 euros per megawatt hour. There's still uncertainty over Russian gas flows via Ukraine. We've seen new and diverging news releases over the past couple of days over Slovakia saying that they could find an alternative provider to Russian gas and still flow the gas via the same pipelines in Ukraine. And you've seen price action on the back of that. But I think fundamentally speaking, it is very likely that we'll see a larger storage draw this winter than the previous winter. So that will probably support gas prices of around 40 to 45 euros per megawatt hour, which is a tad bit higher than the average for this year. So 2024 average gas prices are for the year, it's going to be an average of around 35. We think next year, 2025, will be 40 to 45 euros. And that's mainly driven by weather. So it's an adjustment of following 2 consecutive warmer than average winters. We think this winter on average will be pretty much a normal temperature winter. But other than that, if we take the weather part of it aside, we think that the structural drivers for gas demand are still fairly weak in Europe. That's because industrial activity in Germany continues to disappoint. And it's also on the other hand, is sort of the advancement of electrification. And we think that there will be a stronger rebound in power demand in 2025 than gas demand. And that's mainly because all that wind and solar is, on the periphery, eroding fossil fuel demand. And gas on the power sector will only get support from the closure of more coal plants next year.
Okay, fantastic. Mike, I want to bring you in for just one quick last word before you have to run. So Patricio was talking about the impact of clean energy renewables on the European gas market. Just seeing on the screen from the terminal that the Biden administration has approved California's plan to phase out the sale of ICE automobiles by, I believe it's 2035. How does the energy transition play into your general view on the commodity markets?
Very significantly. And one of the key things first from what Patricio said is declining demand. Most notably, we see recessionary trends in Germany and significant deflationary forces out of China from mostly renewables. The fact that I can make the statement that my EV is 10 years old is one of the best vehicles I've ever owned is a shocker. And that it's just an accelerating process, like I said, from books like The Price of Tomorrow. This is just kicking in. And we had the best incentive in the world to do it, was that Russia's invasion of Ukraine. And so that's why I really appreciate what you do and what's happening. But it's just what's happening with rapidly advancing technology is it might be a pushback with Trump a little bit, but what he's going to do is you can't stop this overwhelming force. And that's like to say in all commodities. I like to point out for U.S. yields of an average acre of corn in this country has doubled from 40 to 50 years ago. And when people talk about the lack of investment in U.S. infrastructure and drilling and stuff, you can drill one drill now, and how many spiders can go out for 4 or 5 miles. It's the technology of drilling and things like that that's just overwhelming. So to me, that's pressure for overall fossil fuel prices. And at some point, it should be in demand for things like copper and metals and silver. But we got to see China get out of this funk first. And it looks like it's going to be. I think it's structural. And I'll end with this. My views on China started when I worked for Japanese firms 30 years ago, when I went to China for the first time 15 years ago, and we should expect more reversion, unfortunately, in that rapidly advancing emerging market, which is normal for rapidly advancing emerging markets that push back and support wars in their neighbors' backyards, according to NATO.
Okay, fantastic, Mike. I know you got to run,
Thanks.
but thank you for joining today. Maybe I'll just sprinkle in a couple of interesting data points. So in the solar space, we've seen some deflationary action this year in the market. So module prices, solar panels, at least the global price has declined something like 30% this year. We haven't seen quite that level of pullback in the United States because of tariffs, but the global price has really been pressured because of a glut and oversupply of module manufacturing capacity. In some ways, it's a little bit similar to that story that Mike and Salih were describing in the oil market. Polysilicon, a key ingredient for making solar panels, has seen a 40% pullback in prices this year. So in some ways, the global commodity landscape is linked, even though these are quite different types of commodities. So, Patricio, I want to come back to you a little bit and hear your thoughts on the idea about the interplay between renewables and gas and coal and fossil fuels generally in Europe. And one of the big ideas that I think ultimately consumers are wrestling with, and so there's this big rhetorical debate, in my opinion, where we're seeing renewables continue to dominate capacity additions in most markets around the world. This isn't just a first world or developed economy type phenomena. We're seeing renewables just proliferate everywhere. We're also seeing rising power prices, retail rates for customers. And I want to get your sense, is the rise of power prices linked to what's going on with renewables? Is it other factors? How do you think about the ultimate cost to customers and how those dynamics of renewables plus the legacy gas, coal, nuclear assets that are on the grid?
Sure. I think a good way to answer that question would be to split between wholesale power prices and retail power prices. So if you look at the wholesale power market in Europe, we still work on a marginal cost auction basis. So that means that the last molecule of power, sorry, molecule of electron, the cost for the last electron to meet the day-ahead demand is the price, sets the price for all of the technologies. So in that sense, yes, in Europe, gas prices still pretty much dictate wholesale power prices. And for example, right now, power prices in Germany, which is a very sort of gas-driven power market, there are close to 100 euros per megawatt hour. That's because they have a lot of gas, and you see that gas is almost 45. So the relationship is about 2 to 2.5 times the gas price. That's more or less the wholesale electricity price in Germany. That ratio changes and goes lower as you go into countries that have a higher share of renewable power or baseload power. So meaning they have a higher share of nuclear, a higher share of hydro, and obviously a higher share of wind and solar. So for example, Spain has relatively cheap electricity or wholesale electricity prices because it has a higher load factor for solar and has a lot of capacity of renewable capacity. So in that sense, yes, renewables can help reduce the cost of electricity because they reduce exposure to commodity prices, which tend to be more volatile. But on the flip side, if we go into sort of the retail aspect of it, customer bills, the fact that we're going into, or we're funding the energy transition, it means that there are a lot of levies on your energy bill that are there to fund or incentivize the transition or the investments into renewables. So that's kind of like the paradox that we're faced with. We have elevated electricity costs for the consumers, but at the same time, we need to fund this immense transition or renovation of the energy system. So I can understand both sides of the spectrum. You can say that building renewables at the moment increase electricity bills because we need to fund them. But over the longer run, like over the long term, renewables or these overcapacities should actually drive, at least if we keep wholesale markets as they are, they should come down as we ease or cut exposure to commodity prices.
Okay, thanks for that. Salih, let's shift gears a little bit and circle back around to your area of focus. Think about oil and the refined product space. How do you think about the energy transition when you look into 2025? And I'm particularly interested in sort of your expectations on growth trajectory for demand. And I think you kind of gave a little bit of a tepid view on kind of the China story. But when you think about where IEA and OPEC think about the demand story longer term, I presume it's outside of the OECD. Which countries is it jet fuel? Is it diesel? What's kind of driving the fundamental demand story over the next months and years from your perspective?
Sure. So, when we were talking about the kind of underwhelming demand prospects in China, what we saw in the last couple of years, and I did mention one of the drivers, which was the turmoil in the property sector. But at the same time, I think we shouldn't forget that the electrical vehicle adoption in China has been quite strong. Again, the argument against this is that the existing car fleet is so big, it doesn't really matter so much that a high percentage of the new car sales in China may be EVs. But I think increasingly we will see things like accelerating EV adoption in a massive market like China, where there is huge domestic manufacturing of these electric vehicles, is going to start making a dent on the oil market. And when we look at the outlook for the refined products for next year, I mean, very briefly on what we're expecting generally for margins for some of the refiners in Europe, and I'll link it back to the demand picture, is I mean, this year has been a year where these refiners, at least in Europe, have seen their margins normalize. In the first quarter, we actually saw margins quite resilient, but that was really driven by the attacks that we saw in the Red Sea, and the ships had to take a longer route around Africa, and that meant higher shipping costs, higher fuel costs, and that actually translated into higher refining margins. But since the first quarter, we actually saw a significant normalization, a sharp drop in refining margins. And this was driven by one, soft demand in Europe, economies really not doing as well as the economists thought at the beginning of the year, especially in Europe. And of course, abundant supply. And we were talking about the crude market earlier, where there is abundant supply, where we are talking about a glut, but at the crude level, there is OPEC plus keeping the barrels off the market. But for oil products, of course, it's a different dynamics. They don't have an OPEC plus keeping oil products barrels out of the market. So we had that abundant supply, ending of that supply crunch that we saw since 2022, combined with soft demand. And that has resulted in this drop in refining margins, and we expect this to continue into next year. And one of the reasons we had abundant supply and higher supply was a couple of major mega refineries coming online. One of them being the Dangote refinery in Nigeria, another one the Duqm refinery in Oman. But on the demand side, I would say generally the way we look at this is that if economies are not doing as well as initially imagined, that usually translates into diesel demand, into lower diesel demand. So I think for the majority of this year, this is what we saw. I think there was a question in the Q&A section about outlook for heating oil / diesel. On the diesel side, again, I'm just looking at Europe. There is a pretty clear correlation with how well the economies do and the consumption of diesel level. On the heating oil side, though, and perhaps Patricio could elaborate on this more and better. But generally, I think the expectation is that if we do get a colder winter in Europe this summer, I think that's going to have the obvious implications on natural gas demand, but obviously it's going to have implications on heating oil demand as well. So we may have a little bit of support by a colder winter on heating oil demand. But generally, higher EV adoption, especially in China, means this could be eating away from oil demand, and that's of course eating away from the gasoline demand. But then in the middle of the barrel, of course, the macroeconomics is very important. Economy is generally not doing so well, usually means lower diesel consumption. And then heating oil, I think, is a bit of a different segment. And just looking into the winter, we obviously don't know how the temperatures will be, but if it is a colder winter, then I think heating oil can get a little bit of support from a colder winter in Europe.
Thank you, Salih. I know you have a hard stop here, so I'm just going to give you 30 seconds to weigh in before we swing back over to Patricio. Just give us a general sense. What are the important themes and catalysts at the top level you're going to be watching for 2025 as you think about the oil market?
Generally, I mean, it's going to be a little bit like repetition, but the major key drivers that I've been keeping an eye on, I will continue to keep an eye on, is what OPEC Plus does. I mean, they're not really meeting monthly anymore. They're really meeting more quarterly. And I don't think there's going to be a major shift in their strategy, but obviously we have to keep an eye on what OPEC Plus, where OPEC Plus strategy is. We need to keep an eye on non-OPEC Plus supply growth. I mean, usually when we say non-OPEC Plus, we're really focusing on the production level in the US, in Canada, in Brazil, and Guyana. I think these are the key drivers. Fed policy, of course, like on the macroeconomic side, is going to be very important. China demand, mobility, and other indicators within China that is important for the consumption levels there, very important. And finally, geopolitics. I mean, perhaps some market watchers are not looking at geopolitics anymore because, technically we had very elevated geopolitical risk in the last year, and arguably it hasn't. The geopolitical risk premium has been very, very negligible. But I would still be watching geopolitics very closely. It's not necessarily only going to be, as I said earlier, just the conflicts in the Middle East or Russia, Ukraine. I think we need to be watching what happens with sanctions on Iran and Russia very closely, especially as Trump comes into office again next year.
Okay, thank you, Salih. Okay, Patricio, I want to come back over to you, but first let me just plug a quick idea here. So many of you who are listening participate in one of our existing client chats, the BI Energy Exchange. I just want to flag that Patricio and I have launched a new energy chat that is available to any clients on the terminal. It's called the BI Future of Energy. And nothing wrong with the BI Energy Exchange, but I've just noticed very oil focused and traditional energy focused. So if you want a chat that's a little bit more tailored to energy transition, wind, solar, gas, LNG, nuclear, hydrogen, these kinds of things, maybe you want to consider joining this. So just ping myself, Patricio, really anyone on this call. We can help you get into that chat so you can have the conversation ongoing all week. You know, myself, Patricio, Salih, we regularly drop ideas into these chats, and many of you discuss, at least anonymously amongst yourself, things that are taking place in the market on a daily basis. So, Patricio, though, I gave Salih an opportunity to close out with just some high level thoughts on key themes and catalysts that he's watching for 2025. And I want to do the same for you. You know, what are the big ideas? Are there any important catalysts that you've got an eye on? Just give us your sense. What are the important things in gas and utilities to be focused on for 2025?
Sure. So I think the first one, they're all not all positive, because the outlook for European utilities earnings next year isn't great, is broadly flat from this year in terms of EBITDA and EPS. And that's mainly because capital spending expansion is slowing down. So we're only seeing an increase of capex of about 5% next year versus a 10% plus increase this year. So that makes regulation, especially for grids, a key catalyst. So for example, today we had a German federal court deny the network utilities appeal for higher returns, which to us means, well, one thing is that the European economies are not in great shape to be subsidizing or to be, investing in grids very heavily. So for us, that's a key theme. It's like, what is the alternative for European utilities? We think that these type of like, let's say, negative regulatory outcomes could perhaps stimulate M&A, perhaps cross-border within Europe or even in the US. I think that's a key theme. European utilities will continue to invest in the US because there's stronger demand prospects for green energy, and just energy demand in general stronger in the US. I think the other key topic that we're going to focus on next year, aside from politics and regulation, is offshore wind. I think Ørsted is pretty much the only pure play offshore wind developer in the world at the moment. Most other operators deploying offshore wind are either infrastructure funds or JVs between oil majors and infrastructure funds. So we think it will be a pivotal year for Ørsted, especially because of Donald Trump's threats against offshore wind and his very vocal dislike of that sector. And also we've seen pretty disappointing results in European wind auctions lately. So this will be a key barometer, I think, for the sector. And I think that kind of tied on the back of that is that we would expect some European utilities to even reduce the amount of money that they're spending in renewable capacity. And that's because, like you said, Rob, prices keep coming down for the modules, for the wind blades and everything. That doesn't really mean that the companies operating these assets are getting the benefits. It perhaps means that the competition to develop these projects is getting higher and higher. So it's getting more cost competitive. So we don't discount a potential reduction of renewable capex across European companies.
Okay, well, we'll have to leave it there. I want to thank everyone for joining us. I've got a number of IBs from you. I will be responding in short order to get you folks added to the chats that you've requested to be in. And I'll just flag, we are going to be off for the next 2 weeks in terms of doing this call. So we will resume on January 8th. Same time, always on Wednesday at 10 a.m. Eastern, 3 p.m. London. Happy to have you join us again. We are going to have some in-person events next year. I know, notably, for anyone who wants to join Mike McGlone and I down in Florida, in Miami, we will be holding an event the last week of February. Specifically, I think we're going to aim for either Feb 26th or Feb 27th. That's a Wednesday or Thursday. So reach out to us. I'm not sure if we'll convince Patricio to fly across the ocean to join us, although he's welcome to. And I hope everyone has a great holiday. Look forward to being in touch. Take care, everyone.